Approaching the portfolio management topic can be intimidating. That's not your fault. For decades, industry professionals have overstated the complexity so that you fear managing your own investments and you hire them instead. That's why I put together this video. I wanted to answer some of the big questions investors might have and reduce the anxiety surrounding this important topic. I'll describe how to think about building an investment portfolio. These strategies apply to an investor who's just starting out on the investment journey and to investors who have already started building assets like stocks and bonds. I'll discuss allocation percentages, diversification, stocks, bonds, and other asset classes like cryptocurrencies. I'll also discuss how to consider various personal financial positions, for instance, if you own your own home, and how it relates to portfolio management. I'll also share with you strategies on how and when to buy and sell investments. And as a bonus, I'll share my thoughts on which asset classes are overvalued right now and which are undervalued. So let's get started after this brief message. Hey everyone, I wanted to take a moment to thank the sponsor of this video. Moomoo is a trading platform that allows individuals to buy and sell stocks and other investments. I posted the link to Moomoo in the description below. If you use that link to sign up to Moomoo, it'll help support my channel, but more importantly, you can get special incentives for using my link, including up to extra 10 free stocks. Alright, so underpinning the entire portfolio management process is diversification. True portfolio diversification is achieved through selecting and holding a variety of asset classes rather than individual stock picking and market timing. This means that diversifying across asset classes, for instance, owning some stocks, owning some bonds, owning some other type of investments, is more important than diversifying within an asset class. For instance, owning several stocks diversifies your equity portfolio, but it doesn't diversify your entire portfolio because you're still entirely investing in stocks if you don't own any other asset classes. Furthermore, asset allocation should not be static. You should always be updating this. Assets' performance and their correlations to each other change, so monitoring and realignment are imperative. You want to observe your performance and see what's happening within your diversification. For instance, you may have started out with a certain diversification, but one asset class may overperform, and now that asset class is overweighted in your portfolio. So rebalancing becomes important, which I'll talk a little bit more about later. Now, there are several ways you can split your portfolio. Here are three common examples: a conservative, a moderately conservative, and moderate portfolio diversification strategy. In the moderate portfolio, which is the one that I've seen most commonly discussed, you have 60% equity and 40% income. Income meaning bonds, most likely. So you have 60% of your portfolio in stocks or equity investments, and then you have 40% of your portfolio in bonds. So that's one common investment diversification strategy. And then you have the conservative one where you have only 20% equity and 80% bonds. The rule of thumb I like to share with my viewers and those that ask me is, as you age or as your investment time horizon shortens, you want to become more conservative in your portfolio. If you have a longer investing time horizon, you can afford to be on the riskier side of the spectrum, which is more equity and less bonds. And as your time horizon shortens, you want to be less risky, which means more bonds and less stocks. Now, when you're thinking about building the optimal portfolio of investments, you have several things to consider. So I discussed earlier how you can have equity and fixed income, right? So we're talking stocks and bonds. But I also like to consider adding some other types of investments, which I like to have, or I like to think of as being roughly 10% of your portfolio, nothing more than 10%. And so when you're thinking about each of these, there's several decisions to consider within each asset class. So let's take a look at those. So if you're thinking about stocks, you can buy individual stocks or you can buy index funds. Two of my favorite index funds are the VBR and VBK. Those are Vanguard small cap index funds, small cap growth and small cap value index funds. Also, when you're thinking about buying individual stocks or index funds, you could think about weighting more towards growth stocks, dividend stocks, or value stocks, depending on how risky you want to be. Growth stocks being the riskiest, dividend stocks being about in the middle, and value stocks being the lowest risk in this category. Also, when you're thinking about bonds, you have different decisions there as well. You can buy individual bonds, in which case I suggest laddering your bond investments so that you have bonds maturing at several times over the next several years. And then you consider whether you want to buy corporate bonds or government bonds. Government bonds being less risky and offering lower yields, corporate bonds being more risky and offering higher yields. You can also do bond funds just like you can do index funds for stocks. You can consider credit quality. If you're investing in a bond of a company that has lower credit quality, you can get a higher yield, but then you're also taking a higher risk of default. And then you can also consider duration. Do you want to invest in short-term government bonds, short-term corporate bonds, or long-term government and corporate bonds maturing in 10 years or more? Those are decisions to consider within the bond portfolio. So it's not just saying 60-40 stocks and bonds. Even if you choose 60-40, you got to narrow in on the individual asset class and make decisions based on your personal preference. Now, in the other asset class, I've put in real estate here, commercial, single family, multifamily. There are several types of real estate you can own. And my advice regarding real estate is, if you have experience in the field, for instance, if you're a real estate broker, if you're a real estate agent, then maybe owning and investing in real estate, physical property, might be a good fit for you. However, for those of us that don't have experience in this field, it may not be such a smart investment because you don't have that competitive advantage within the industry to deliver above average returns. Now, you also have other asset classes like gold, silver, and cryptocurrencies. These are assets you can have in your portfolio as well. And finally, collectibles like art, sports cards, etc. This is kind of a fun asset to own because it's something that you enjoy owning, you enjoy looking at. And so it serves a couple of purposes. Not only does it add to your investment portfolio and diversifies your investment portfolio, but it also gives you something as like a hobby. It kind of gives you some sentimental value in addition to investment value. So I always like to look at portfolio management comprehensively. So you look at your overall picture. You don't just look at your portfolio of investments separate from your other areas in which you're generating wealth, such as, do you own your own home? If you own your own home, then I would highly advise against investing in any other real estate, whether it be another home, whether it be investing in a real estate investment trust, because if you own your own home, it's probably already a large portion of your overall wealth. Home values have absolutely soared over the last 5 years. So if you own your own home and it's worth $1 million and your investment portfolio total is worth $500,000, more than 2/3 of your total wealth is already in real estate. So you want to diversify away from that. You don't want to add any more into that category because you're already so heavily invested in real estate. So if you own your own home, you have to consider that in your portfolio diversification strategy. You also need to consider if you're a wage earner or business owner. If you're a wage earner, that's less risky and that is more bond-like in nature, versus if you're a business owner, that's more risky and that's more equity-like in nature. So that means if the economy as a whole performs really well over the next 20 years and you're a business owner, you will probably do better than if you're a wage earner in those 20 years. So you're more exposed to economic ups and downs as a business owner than you are as a wage earner. So you want to consider that in your investment portfolio diversification. If you're a business owner, you're already taking more risk. And so when you're thinking about your investment diversification, you want to take less risk in your portfolio because you're taking more risk in your career, in your income earning. And then finally, do you work in an economically sensitive industry such as travel, car sales, or retail? If you do, that means, again, you're more exposed to the economic ups and downs and more risky, right? So you have more upside, but you also have more downside when the economy goes up, and you have more downside when the economy goes down. And so you want to consider that in your portfolio. If you have a more risky career, then you want to have lower risk in your portfolio. All right, so what about buying and selling? When should you buy? So my advice here is to allocate across asset classes regularly, whether it be monthly, quarterly, semi-annually, or annually, meaning you say to yourself, every first of the month, I'm going to allocate $1,000 to my investment portfolio, and I'm going to split it, 50% in equities and 50% in bonds, whatever your personal decision might be in that area. Whatever that decision is, allocate regularly, every month or every quarter or every 6 months. Set a process and just disciplined allocate. Buy every month, every 6 months, every year, and do that over your entire investing time horizon. Also, you want to rebalance regularly or when one asset class exceeds the desired proportion of your overall portfolio. So you want to look at your portfolio at least once a year and see if the percentages are where you want them. If there's a big misallocation, meaning if one year, let's say, bonds really performed well and now your portfolio has too much value in bonds because they went up in price by so much, you can take the time to reallocate, sell some bonds, add more to equity so that you're balanced again the way you like it. You do that regularly as well, every year at the very least, more often if you have the time. So what are the big takeaways here? Portfolio management should be considered holistically. You have to consider your entire picture of generating and building wealth, not just your investment portfolio, but also your job, your career, how you make money. The shorter your investing time horizon, the less risky your investment portfolio should be. Looking at risk, government bonds are on the lowest end of the risk spectrum, while cryptocurrencies and assets like that are on the highest end. If you have a stable career, like a teacher or a nurse or an accountant, then you can take more risk in your investment portfolio because as a teacher, you're not really exposed to the upside of the economy, right? If the economy performs really well over the next 2 decades, are you going to make more money as a teacher? Probably not, right? Your income is not correlated to economic performance. And so in your investment portfolio, you can invest in a way that gives you access to the upside of the economy. And then finally, you want to understand your risk tolerance, regardless of your ability to take risks. You might have a great investment portfolio with an abundance of assets, and you may be in a position to take a lot of risk, but your personal preference, you don't like to take risk. And so I always suggest you understand your risk tolerance and don't take any risks you're uncomfortable with. You don't want your investment portfolio to cause any unrest or unnecessary turbulence in your life. So consider your take on your personal risk preference. And as a bonus, so which asset classes do I feel are overvalued right now? Single family homes, I feel, are extremely overvalued. And I think there is unstable housing prices across the board in the United States. This is a category I would try to diversify away from and try not to expose yourself anymore to this market because I feel there's very limited upside and significant downside here. As far as the stock market, I feel like it's fairly priced. I don't think it's cheap. I don't think it's expensive. And US government bonds, I feel, are undervalued. Investors can get yields upwards close to 5% investing in longer-term government bonds, which I think are a good value right now. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.